Hello YouTube, what is up? My name is Reese and today I'll be back at it again with another video, and in this video I will be talking about why you should potentially consider a ETF versus picking and choosing individual stocks for your portfolio. Now, I'm not saying that by any means that individual stocks are bad. I'm simply providing a case for why you might want to consider adding ETFs to your portfolio. And to start off, if you don't know what an ETF is, an ETF is an exchange traded fund. And typically, what an ETF is, usually they're designed to track a certain index. And it can be anything from an S&P 500 index to a sector index, such as an energy growth index, value index. There's index funds for everything out there. You can go to a website like ETF.com, and there's literally hundreds upon hundreds of ETFs for anything that suits your needs. And what it comes down to is an ETF is a basket of stocks, meaning they have basically pick and chosen all the stocks for you in that index fund. You can simply, for example, if you wanted to buy the S&P 500, you could simply buy one ETF of it rather than going and buying 500 different companies. Similar with the example that I'll be talking about in this video is that XLE, which is the SPDR energy sector ETF, and it is a composition of stocks, of energy stocks, basically just to represent the energy market as a whole. And the reason why I make the case for ETFs over potentially picking and choosing individual stocks was a pretty interesting analogy that I heard recently, which I found to be quite representative of what an ETF really means. So, and the analogy I heard recently was, think about if you were a farmer, would you rather, if you only owned one or two cattle and a cold winter came and that cattle died, your portfolio is going to really hurt because you're putting all your money into betting on one or just a few cows. And if that cow died, you really feel the effects. Now, on the other hand, if you had owned a entire herd of cattle, when that cold winter came, yes, some of the cattle may die, but some of the cattle will do really well. So you're hedging your risk, meaning that you're less likely to have an extreme blowout one way or the other. So if you're investing in a growth stock, for example, you have a high risk, high reward. You could potentially lose everything, or you could potentially have a stock that pulls up 1,000% gain. So you're really investing in riskier assets that could go one way or the other. Whereas when you're investing in an index fund, it is a diversified by nature because you're holding multiple companies across potentially different sectors or competitors, so that you're less likely to get zeroed out. And so what I'm going to be talking specifically about is this energy sector ETF. And I think it's a good representation of what I'm trying to talk about. So to start off, what this is, XLE is the ticker, and it is designed to track the energy sector as a whole. And top holdings by weight are ExxonMobil, Chevron, ConocoPhillips, Occidental Petroleum, EOG, Pioneer, Marathon, Schlumberger, Valero, and Devon Energy. And you can see that these are weighted by market cap. So ExxonMobil is currently the largest publicly traded energy company. And so that's why it has the most weight. And now we're going to look into the returns. So this is XLE graphed over time. And as of right now, if you had invested in 1998, December 1998, you would have got a 240% return. Now, keep in mind, this is significantly lagged the overall market because energy is, as a commodity, is relying on crude oil, and it's cyclical. So you're going to have periods, especially like in 2008 where we had a huge rally in oil, where that didn't get, it eventually recovered, but then we've seen, especially during COVID, it really hurt. And now they're doing well from higher energy prices. So let's say you had invested, instead of investing in this index fund, let's say you invested in ExxonMobil. ExxonMobil is a fundamentally sound company. They're the largest in the world. And ExxonMobil actually has underperformed this index fund. Let's look at Chevron. Chevron underperformed the index for the majority of its life, except until recently, where there has been a slight overperformance. Okay, looking at BP, BP has significantly underperformed. Shell in purple has significantly underperformed the index. Schlumberger, it mirrored the index for a little while and then started underperforming. Halliburton, I'm going to take some of these off, has also kind of mirrored the index for a while, but is underperforming. So the point I'm trying to get at, specifically for these energy stocks, is the reason why is not all energy companies are created equally. Some have different goals and agendas in mind, which have really differentiated that one from another. Even ExxonMobil and Chevron, they're two energy giant corporations, but they have kind of different mindsets when it comes to the role of energy and what the future might hold. For example, one company might be investing a lot into carbon capture, and one might be looking into the utilization and storage aspect of it. And so they're looking at different ways of looking into the future. And so another way to look at an index fund is just say you have two competing companies. You can choose either stock A or stock B. This is purely hypothetical case. Stock A and B, you're investing in the early days of a new sector, and so you really don't know which one's going to take off. So let's say you invest in stock A, and stock A files bankruptcy and can't handle the changes, and company B skyrockets. If you put all your money in stock A, that would hurt really bad. But on the other hand, if you put your money in stock B, you would have done really well and you've been happy. But you don't know what's going to happen. You don't know what companies are going to overperform the market and which ones are going to underperform. And so utilizing ETFs can help you hedge your risk. So you're minimizing your downside risk in the sense that the S&P 500 isn't going to file bankruptcy and go to zero. Knock on some wood that no crazy stuff happens. But even like during the financial crisis and global economic meltdown events, the S&P 500 is always recovered in the end, because an index fund, these stocks can rotate in and out of an index fund. So it can always replace itself with new companies that if an older company goes bankrupt for whatever reason, it can get replaced with a newer company. And that's something to keep in mind. You don't want to be holding a company and you're putting all your money, your life savings into it, and then 30 years down the road, it goes bankrupt. Think about Enron. If you haven't heard the story of Enron, Enron was a Houston-based energy company that used false accounting principles to really boost their stock. They encouraged all their employees to invest in their stock, and the stock was doing very well until they got outed for bad accounting practices. The entire stock plummeted, and it went from being over $40 a share to like 1 or 2 cents. So it got completely wiped out. Now, ideally, you're not investing in crappy companies that'll do that, but there's always a risk that something could happen to that particular company. So investing in an index fund can help diversify that across multiple companies. And at the end of the day, diversification can be key to a healthy portfolio. Now, with that being in mind, if you really believe that a certain company is going to pop off, or something that you truly believe in holding for the long run, that's great. It's investing in an index fund, though, is going to give you back potential time, because it's saving you from doing the research and nitpicking through financials to figure out what a good company might be, versus investing in that index fund, just set it and forget it, let it sit and do its work for 20 or 30 years. And so hopefully that made sense. And I'm going to reiterate, this is simply proposing an idea of why you might want to incorporate index funds rather than an all stock portfolio. Now, each has its own place and use depending on your situation. It all comes down to your personal specifics as far as risk tolerances and what your portfolio goals are, whether it's short or long term. So it's just thing to keep in mind when you're choosing a portfolio. I personally, especially for my Roth IRA, I'm basing that off ETFs. That way I can just invest it in it and let it sit for the long run rather than having to worry about shifting money around individual stocks. And it's just saving me the headache and time. Just investing in a total market fund like VTI is something I believe in, or dividend stocks such as SCHD, VYM, and VIG are also healthy options. So it's always just comes down to what you're personally okay with. So I hope you guys found that useful. Thank you guys so much for watching. I really appreciate it. Every like and subscribe helps fuel the fire to keep these videos coming out. So I hope you guys found this useful. Thank you guys for watching. Hope you guys have a great day. Thank you.